This is Conversations, a weekly financial podcast featuring interviews with leading investment strategists, noted technical analysts, and other key thought leaders. Brought to you by the Market Technicians Association.
Welcome to Conversation, the official MTA podcast. I'm here today with Andrew Gebhard. Andrew is managing partner of Finex LLP, and we'll be giving a presentation on intraday trading strategies. Andrew is the managing partner of Finex LLP, a small UK investment management firm with a listed usage for fund running models based on pure technical analysis. Both the presentation and the interview itself have been videoed and are available to watch on the MTA website, along with the archives of all the UK chapter, monthly meeting, technical presentations, and presenter interview videos. Now, without further delay, let's talk to Andrew. Andrew, welcome to the show. Thank you very much for joining us.
Pleasure.
Today you'll be giving a very interesting presentation, much away on intraday trading strategies. Let's begin with some information about your personal educational background before getting involved with technical analysis.
Okay. Well, I was brought up in Italy, went to a British school over there. I grew up always wanting to be an engineer. I came to Britain, did my university, became an engineer, and then I hated it. So I ended up being an auto engineer temporarily in France, and the French recession stopped that. And I found myself back in London. Through completely random meetings, I found myself trading Eurobonds briefly, and then on the live floor, broking and market making Bund and BTP options, which was very, very exciting. Very, very exciting. I saw the end of that era. So from 98, as the exchange was dying, I moved to Lehman Brothers, where we started looking at trading options in a systematic way. So basically looking at the option as its purest sense. In effect, the option being a fixed or a short delivery future, rather than looking at it in terms of data mining the actual prices. That was very exciting, and then that brought me to the systematic side of futures trading.
Got it. And how did you get involved with technical analysis? How did you learn the craft on your own or through someone else?
Through people I met. Mm-hmm. I met people that were already very much involved in the futures side, and they were in fact the people that dragged me into futures, because I was very, very much concentrating on the option side. We were trading quite a few options models at the time. They thought it was a good fit. Then my analytical methods in the options were reasonably different from the way that they were looking at the market. So I was looking at basic statistical approaches, which then transforms himself into things that nowadays are reasonably easy to compute, like maximal favorable excursions, maximum adverse excursions. But we're talking, the end of the 90s. The end of the 90s was the beginning of the internet. So things were very different. The platforms you had were very different. So a lot of this analysis tended to be done, either on pen and paper or by Excel. Again, nowadays we are very much full of beautiful platforms that can do things that we only dreamt of 15 years ago. So I found myself in technical analysis because people dragged me into it, kicking and screaming. But it's been a fantastic journey. It's been really great to be able very early on to use different methodologies. And I think that people always say, well, you started off on the sales side. How difficult was it to break from sales to trading? And it was extremely hard. But at the same time, the sales side gave me the possibility to observe thousands of people trading, the fears, how they deal with their orders. Simple things like the idea that the care and attention that is taken on entry and the abandon that is taken on a stop. Mm-hmm. The stop is always treated so much worse than the entry. And yet, both of them give you an equal amount of profit or loss. In the case of a stop, a loss. But all these kind of things you can't appreciate, I think, just by looking at a chart. And because of the nature of institutional sales, you have access to so many people, so many styles, so many different ways of looking at the market. And so you get a real flavor for why things are happening, rather than just the physical result, which is future moving by tick or by 6 points or whatever.
Okay, can you, now that you're managing partner of Finex, can you give us a description of the firm, your day-to-day responsibilities, and lastly, the most challenging aspect of your work?
Well, Finex LLP was created in 2010, basically born out of the frustrations with the pace of technology on the institutional side. I mean, especially when you see, the likes of even CMT, what retail is able to use. I think that institutional customers now have lost the game. They will never catch up with what retail can have at a price. The idea that someone with a $5,000 account can access a charting package with execution, with research, which would cost in the retail space $5,000 a month, and it works. That's very, very exciting. And I was in my previous situation, I was getting very frustrated at the sort of the length at which of the projects and how long everything would take. And also I thought to myself, this is, the conditions are right for me actually to start on my own path. The intention was always to build an investment manager, but to do so as a small firm is quite hard. So we decided firstly to build the execution side, then the managed account side, and the managed account side at the moment is vastly larger than the fund side. And slowly as we progressed, the permissionings and all these things take time. The execution side has effectively been there as a vehicle to allow us to do everything else. So consequently, we have been profitable every year as an entity because of all the various elements in the company. Even on an IT side, we did some IT consultancies for some firms, which makes things a lot easier, slower, but also from a cash flow point, positive, which is nice.
The end, the bottom line.
Absolutely. You have a different kind of level of decision making when you know that you have a little bit more time to make that decision.
What would be, so because the firm is so varied, what is the most challenging aspect of your job? What do you think is the most intriguing one?
Switching off my computer. When you have your own firm and you're growing. Every year we've been growing 2-3 people every year. It doesn't sound a lot, but it's like 50% growth every year in terms of personnel. Detaching yourself, and saying, what, I'm now going on holiday. I've got 2 little kids and daddy time and these kind of things. That's probably my discipline to actually close my computer, switch off my iPhone, and not look at my email.
Got it. And today's presentation is will be actually quite interesting. Will be on intraday trading strategies. If I'm not mistaken, one of them will be the opening range breakout.
Yeah, there's a strategy along those lines. Yes.
Could you give us a brief mention of your favorite tools and techniques? What do you specialize in?
That's a very hard question to answer.
For example, if I may jump in, I was at we were at your office just like an hour ago. So, and you mentioned about how you use volume or patterns.
Yeah. Fundamentally, we try and segregate market conditions and create a series of imperfect solutions for each market condition. Mm-hmm. So we don't believe in a super system. We are not capable to do large statistical arbitrage kind of trades. Personally speaking, I think it's a game for other people. It's a latency game. It's that kind of thing, and it's wildly beyond our scope. And it's something that I've never done. But what we have done, and what we seem to be reasonably good at, is creating little systems that trade very well in certain conditions, but don't lose too much money in other conditions. And most importantly, as we were talking in the office, the idea that their losses are totally asynchronous because their construct is completely different. And one thing that came to me as I was walking here is the idea of correlation. When we were talking about the milk futures thing, so I'll trade Spanish 10-year bond futures. We'll have an open interest of about 300 lots, I think. I'll trade milk futures, and the two will never be correlated. Of course, they're never correlated. But what happens when they don't move? You see, that's the thing. So you have conditions where you run a long correlation, and your correlation is low, 0.2, 0.3. So fantastic, very diversified. But the problem is that both of them can halt at the same time. And if you have trend following strategies on both, you lose money on both strategies. So why not pick milk futures and run a mean reverter and a trend follower on milk futures at the same time? And that way, when the market does go into stasis, your mean reverter takes over.
Got it. Or as they say, in times of crisis, all correlations turn to one. For example, you've got, because pretty much everyone's selling out of their positions, and you've got seemingly fundamentally uncorrelated markets, just
completely
trending either the same way or trending the same time.
Which is what happened in 07, 06, 07. So as all the correlations became more stable, you had to risk more and more for the same return. And suddenly, when it goes boom, the physical positions are so large, and the disjunction of the correlation is so abrupt that you do have very erratic moves in the market, which are completely very difficult. But as we do as a group, as technical analysts, to a larger extent, we don't really care. All we want is to make sure that we have the tools that when some dysfunctional occurrence happens, that we are prepared for it.
And which brings me to my next question. How do you approach looking at a chart? For example, if I put a chart of you in front of the chart of the S&P 500, say, what would be like step one, step two? I mean, how would you approach?
Well, for example, if someone asks me an opinion on the market that I've never seen before, or where I don't have an assumption about be it fundamental or technical, I'd probably start without any indicators at all. And I think that this is something that we've lost a little bit. On one side, it's fantastic that we have all these other tools. But on the other side, we as experienced human beings are much better at spotting patterns than certainly computers. If not, computers would have beaten us at chess 30 years ago. They can't. And chess is a closed system with fixed rules, let alone a market. So I think that's the first thing I would do. And I think that's very powerful, and I think a lot of people forget that they are actually quite good at this. But sometimes they just lack the confidence to just look at a chart without any indicators whatsoever. And then what I'm going to try and show in the presentation as well is that without ruining a little bit of the story of it, but basically we sort of add complexities and make things look nicer and nicer and nicer, and then we look at the beginning at something really banal like EMA breakout, and we see that in fact the EMA breakout works. Okay, you can add finesse and things like that, but you look at super simple things, and super simple things still work. And it's crowds moving. Crowds moving has a certain amount of momentum. When crowds don't move, they have also quite an amount of stasis. The longer a crowd doesn't move, sometimes the more of a push it needs to move. So, I think that the next indicator I would probably put in, and as simple as this might sound, would be a simple exponential moving average.
Simple as that, as a trend tool.
As a breakout tool,
yep.
Rather than a trend.
All right.
As we're going to show as well, if the crossing moving averages and all the systems developed around that kind of basic methodologies are extremely attractive. They look beautiful on a chart. They keep you in a trend for a long time, MACDs and things like that. The problem is the cost of entries can be huge. The longer it keeps you in the trend, the longer it takes you to get into the trend. And the problem finally, fundamentally, is when the trend stops. I think from an investor side, long are the days that people are prepared to take 6 or 8 months of effective drawdown before you can see a trend again. I think that people don't have that kind of patience anymore. And consequently, you need to have something that feeds the trend follower when there is no trend. And that's intraday strategies.
Got it.
Intraday strategies for us, for the smaller traders, are a great place to start. Super cheap, just intraday margin. And
spin the wheel more times.
Sorry?
You can spin the wheel more times.
Yeah, but also large institutionals don't want to be involved in intraday, because unless they're doing these high frequency statistical arbitrage kind of correlation trading, because the scalability they consider to be very low. Again, single system models will have all the problems of a larger model. You have single entry, you're trying to push the market. You can test the market and decide, look, will the market take it or not? But ultimately, very, very large funds can't do intraday. And what happens? All funds end up trend follower. And that's the last slide of the presentation, is there on purpose. And what I'm trying to demonstrate there is something that I think a lot of people know already. And sometimes you look at all these indices built on funds which are completely diversified in their nature, and yet the results are identical.
Which people have been your greatest influences? For example, if I asked you to pick 3 technical analysis books or 3 authors, which ones would
I think
be?
they're probably the same as most people. I mean, Elliott wave analysis, certainly. I think the very first book I read was Short-Term Secrets to Long-Term Trading by Larry Williams. And then the Toby Cable's book, which I didn't have a real copy of. He made his name by buying back all the books, of course. That's a great story. Fantastic PR, More better than to sell the book and then try and buy it back. I mean, it was an instant success. But, the guy is very successful still. His fund's doing phenomenally. You can't argue that. Yeah. I spent some time on DeMark. And I think those were influence. I must admit that Larry Williams was probably the book who I still, out of which I still use quite a few little bits and pieces, more than any of that ones.
Yeah. I can speak for myself. It's been the greatest influence in my work as well.
It's strange for a lot of people, huh?
Yeah. I know he's many generations.
Yes.
Larry and John Bollinger as well. Okay, technical analysis principles. If you could distill your market knowledge in a few axioms, which ones would this be? For example, don't fight the tape, or.
I think that's easy. That's for me. It's very easy, and there is no perfect system. There's no super system. I think that's definitely the mantra that has driven me from day one, and I think will continue to drive me in the future, hopefully a long future.
Great. If you could give a call to 25-year-old Andrew and have a chat with him and give him some advice regarding markets, career, going forward, what would you tell him?
See, I'm a little bit of a fatalist. I believe that certain things happen for a reason, and you can't engineer your career too much. And at the risk of sounding a little bit boring, I probably wouldn't say much. Not to spoil the whole process, because without the mistakes, without the frustrations, without the losses, and you're not the same person. So yes, I would probably talk about the weather.
Great.
Or give him some results for the lottery or something like that.
Which even better.
Here's right. A bunchal for the next 10 years, guys.
what better advice could you do than that? And all right, so which brings me to the last question. Fun fact, talking about the weather. How do you relax outside of market hours? I mean, do you have any hobbies? I mean, you mentioned your family, of course.
I have a gigantic amount of hobbies, from building things for my children. I don't know, sort of modifying cars, motorbikes. I spent a long time tinkering with motorbikes, Lego with my son. I have enough hobbies, 7 lifetimes. I spent a long time in hospital in 2004, so I started building tanks, big tanks with smoke systems and things like that. What I try not to do is I don't do any markets. I try not to
switch off. I know exactly what you mean.
But I think that building things with your hands, like little hobbies and things like that, firstly, doesn't seem to be very popular anymore. But for your mind, it's fantastic. it's a fantastic detachment to actually do something which gives you a result, whatever that may be, either a happy child or something nice to look at. That's very important, I think.
That's a great way of looking at it. Okay, I think that about wraps it up today's MTA podcast. My guest was Andrew Gebhardt, and for the MTA, I'm Alex Piroglu, and I'll see you at the next chapter meeting. Andrew, thank you very much.